Thanks so much for that, Sumit. I think now more than ever, investors want to really understand best how to go about and build a portfolio that's also a secure portfolio with an eye to the future. So let's dive right in. Um, Satyabrata, let me start off with you. In terms of how you perhaps advise investors to go about picking the right stocks at a time like this when things are so uncertain. It's very difficult to really predict which are going to be the companies that will lead us into the future. What would you advise?
See, during these times, or during most of the times, typically the type of stocks that I would recommend internally to our team, and also while selecting stocks for the funds that I manage, would be typically look at companies and sectors which have long-term potential going for. The opportunity size should be large, and the companies preferably they should be leaders in their sectors, and there should be a track record of delivery in the past, so that we're not just betting on just a story but actual real operations. They should have executed it on the grounds in the past few years. And of course, at this point of times, you would look at companies which have an extremely strong balance sheet, because at this point, when nothing is selling, none of the companies or sectors are able to sell at this point of time. So it's going to be a stressful scenario for the next 3 to 6 months or maybe 1 year. So it is essential that the balance sheet is strong enough that you can withstand this stressful period, or period when your cash flows are quite stressed. So a strong balance sheet is essential at this point of time.
Okay. Anil, let me have you dive in as well and share with us a strategy that you're going by. If there are any particular kinds of funds perhaps that investors should look at if they do have the capital to get into markets at these levels.
So, right now it would be a good idea to, first of all, have a clear, 2 to 5 years perspective when you invest in. So don't look at, daily NAVs and daily stock prices. It's going to be a pretty choppy period ahead. I would generally request or suggest to them to look into buy either large cap or multi-cap categories and funds, primarily because these are better researched stocks, and with better corporate governances, better boards, better bandwidths, better balance sheets to take on shocks. And right now we are in a period of a shock, and the globe is in a period of shock. So I think clearly, for them, two things are important. Please look from a 2 to 5 year perspective. And second, for now, try and avoid the smaller companies, be in large caps or multi-caps.
Okay, sound advice coming in there. Ajay, what about you thematically as well? Is it wise currently to go about a sectoral view? Would you stick to a very stock specific approach?
So basically, I generally tend to avoid a sectoral approach. I tend to be more company specific, because once we start talking about the sector, then there itself we are surrendering to a commoditized world. So within a sector, we see like not many companies uh, are are somewhat similar. So it is all about the uniqueness of a company that counts the most. Amazon, Apple, Google, Microsoft, these are quite a few examples where they can be called as technology companies, but it is all about the very unique feature of these companies that make them tall and are $1 trillion companies.
Okay. Vishal, with so many mutual funds being offered right now, what about PMS? How does that add value to an investor's portfolio?
Yeah, sure. So I think the way we look at it is that PMS complements mutual fund schemes. For any investor, mutual funds will be the core part of the portfolio. However, PMSs do offer strategy diversification. So from that perspective, it does appeal to a niche segment of investors who are HNI investors who are looking to diversify beyond mutual funds. Uh, and in that case, for example, in our PMS, we have got certain strategies like innovation portfolio, or for that matter, uh, uh, India Special Opportunities portfolio, which looks at investing in turnaround stories. So such kind of investment avenues is something that is differentiate the difference. It's different from mutual funds, and it adds value to investors. So that's how we look at it.
Okay, fair enough. Anil, let's get a bit more deeper from, in terms of the kind of themes that are likely to play out. We've understood the kinds of companies perhaps that one should look at, but there's been a lot of focus on, let's say, financials on one end, pharma on the other end. Would you stick to perhaps those handful of financial names that seem to be driving the way forward, as opposed to, let's say the slightly more defensive names where perhaps growth may still be a little bit more muted?
So, there's no, it'll have to be a combination as far as approach of the fund manager is concerned.
Sure.
You need to first really clear that you need companies which will withstand the next, 12 months, which is going to be a turbulent period from a business perspective. The stock price could, do what it does. So, you need to be sure that these companies will basically see through this period without any major deterioration in the balance sheets, number one. Two, as and when normalcy starts coming in, these sectors and these companies should be the ones which should take the lead in terms of gaining market share, in terms of a better, top line growth, better margins, and hence better profitability. So, this is what you really need to focus on. And this is what, one is right now doing so. Your questions on, banking, the size of the balance sheet really matters the most in a bank. So a smaller bank, obviously, in these kind of times, is far much more prone to difficulties and far much more prone to issues, which could not necessarily be handled easily. Banks is all about raising capital at the right time. And, from that perspective, it would be a sensible approach to be into larger, well-capitalized banks.
Oh, all right. In terms of, if we take a look also at valuations currently, and Ajay, let me come to you on this. It starts to look very attractive when you see some of these companies trading at these kind of valuations. However, on the other end of the spectrum, some are still actually looking expensive given the kind of crisis that we're going through. How would you assess valuations at this point?
So, what has been my biggest learning is valuations, though they matter, the entry price matters. But what matters much more is the getting hold on the earnings growth and the market share incrementally the companies are going to command. So most of the times in the market, when we talk about the valuations, we try painting everything with the same brush, and we kind of use a P or EV by EBITDA. So these are just one of the very few matrices when you evaluate a company. So it is all about market share gains. What are the moats around the company as the company grows from being a small to mid-size to a large size company? So are they building moats around the same? So otherwise, what may happen is as they grow, like in technology companies, we have seen a company may grow for some time, but then you'll have suddenly competition coming in. So those Kodak moments we need to avoid. So once you have the moats surrounding the company as the company grows and is able to manage the change much better and is quite grounded and doing a lot of ground research, they are ahead of time, spending significant amount of money as a percentage of sales in the research. So generally, these are the companies that command a high valuation, and rightly so, they should command a high valuation, though it may look high in the short term, but 2-3 years down the line, you realize, it was a quite cheap.
Right. Okay, Satya, we've got a question for you coming in. What's your call on NBFCs as your portfolio seems very well balanced? That's coming in from Sholay. He's asking that specifically to you.
See, as far as NBFC goes, one of the sectors where people think that there is going to be a huge impact because of this current crisis is in the banking and the financial space, especially in the NBFC space. And there are expectations that job losses will happen, and so there could be a large amount of NPAs in that sector. So I think what will happen in the NBFC sector is that in this kind of crisis, what happens is the better one, the top 2 or 3 players in that particular space actually stand to benefit when the crisis gets over. So I think it's better to shift your holdings as what we have done is that we have shifted out from quite a few of our NBFCs and consolidated our NBFC exposure into the top 1 or 2 companies. So I think it's going to be a stressful environment going forward for NBFCs. So we have reduced our exposure and concentrated on the top 2 ones.
Okay, I'm going to get to more sectors and stocks in a moment, but just a question for Vishal as well. On PMS portfolios, Vishal, there seems to be a perception that they have to be mid-cap, small-cap centric, and therefore take excessive risk to generate alpha. Is that correct? Because I can see that you've also flagged a few large-cap funds that are actually doing quite well.
Yeah, sure. So, Abha, we believe that, fundamentally believe that there is no relationship between high risk and high return. There are opportunities in the marketplace to generate decent long-term returns without taking too much risk. And that's been our philosophy in our portfolios, all our portfolios, to focus on risk-adjusted returns. And also coming to this art and science of investing, we believe that investing is a combination of both science and art, and we believe it's a science of exclusion and art of inclusion. So, for example, for selecting the right, for eliminating the bad stocks, one has to have scientific parameters, be it in the form of leverage, low debt to equity, high return on equity, etc. And then from an art perspective, one has to use judgment, one has to understand the business model and the quality of the management, and then finally decide which stock to select. So we believe it's a combination of both, and that's what we practice here. And our flagship fund core equity portfolio is having 75% exposure to large caps, and has been doing quite well over the last some time.
So actually talking about that, that was the best performing scheme from 2013 to 16, 40% CAGR versus 15% for the benchmark during that period. Then it underperformed for some time and then has again recovered. So what are the learnings there, Vishal?
Yeah, sure. So I think clearly it was a very humbling experience. We had a few one-off events end of 2016. One was demonetization, which honestly was a black swan event. And post that, a couple of stock-related events happened. One pharmaceutical company got an import alert. So the learning was that one has to actually be prepared for black swan events while one is creating a portfolio. One cannot rule out the possibility of black swan events. And therefore, while creating a portfolio, one has to look at, apart from quality and growth, one also has to look at the resilience of business to withstand such kind of pressures. And secondly, also diversify the portfolio into some of the sectors which are laggards and have gone through temporary correction and are coming back on track.
Right.
Pharmaceuticals, for that matter, was having a painful period over the last 2-3 years, but it has now started to pick up. Similarly, telecom, for that matter, has been a laggard for 8 years, but over the last 1.5 years, it's done well. So I think we have diversified into such sectors like pharmaceuticals, telecom, and some of other sectors like insurance, which is what has helped us to come back on track in terms of performance over the last 1.5 years.
All right, you touched upon pharma, so let's talk about that then. Ajay, it seems to be a sector where everyone's starting to look confident that it's going to bring about fresh set of leaders, given the potential that we're seeing there under the current crisis. What's your take when it comes to some of the pharma names and the kind of return possibility they offer?
So when we talk about pharma sector, we need to differentiate the companies that are serving to the Indian consumers, and the companies that are generic in nature and serving on a global platform, manufacturing in India and selling overseas. So in India, if you see last 5 years, the pharmaceutical industry has grown around 10%, and it has been the most consistent and highest growing industry. Next 2, 3, 4, 5 years, it is actually expected to grow minimum the same percentage, because as we go north of $2,000 per capita income, the healthcare spend is only going to inch up. People focus more on health. So COVID is okay. It is going to accelerate the trend. So the trend is good, more so for domestically focused companies.
Okay, fair enough. Anil, especially after the recent set of announcements, we've now had a couple of press conferences from the finance minister, more to come. Does that give you any sense of conviction that there might be a few pockets that will see some amount of economic activity start to bounce back?
Yeah, surely. I mean, when you move from zero to anything, it definitely helps. I mean, it's been a long wait for the stimulus to come through. We started seeing signs of that. Yesterday was a large announcement from the government in terms of trying to help the MSME sector. To me, it's a great start. It will definitely make sure that these companies which were standard possibly have a great chance to survive this very difficult period. As I mentioned in my earlier reply, these are companies with very thin balance sheets and really need a lot of helping hand in these kind of events, which are completely out of anyone's control. And I think this will go a long way, if you ask me, in trying to help the economy move forward. Remember, MSME as a sector is one of the largest employers as far as this country is concerned. And if you can get your employment going, I think that itself takes care of domestic demand. That itself takes care of domestic economy, if you ask. So yes, I think it's a great start. And as you rightly said, more to come.
Okay, Ajay. In terms of identifying some of these stocks, I mean, I know when we're talking about picking the larger names, the ones with the strong balance sheet, we're anyway narrowing it down a fair amount. But given the current environment, have you, looked into a certain amount of reshuffling? Have you taken a closer look at perhaps some of the earlier favorites that may not have the potential to perform as well in the current downturn?
So, about this exercise keeps happening within our team on a daily basis. We myself with a group of analysts and the other team members, we keep tracking the change, and change is what matters, especially so post Demon, that was way back in 2016, and after that we saw GST. Now we are seeing COVID. So these were the trends which were already happening, and we were moving from a physical economy to a digitized economy. So a portfolio doesn't change overnight. When you discover things are not going to work out, and you discover there can be Kodak moments, so these stocks they find their way out of the portfolio. But we try to get into the companies quite early, and not many companies in our portfolio would have been there for like 8, 9, 10 years. And it is all about the company management and the leadership and the promoter category which it belongs to. They are ahead of times. They keep cash. So I'm not a believer of keeping cash in the portfolio. My companies, they have cash in their portfolio. So whenever there's an opportunity, they can just acquire and grow inorganically as well.
Okay. Satya, I have a question for you again from a viewer. Sunil Kamdar is asking if you could share your journey of the ABSL Balance 95 scheme.
Well, Frankie, ABSL Balance 95 scheme, I took over around 15 days back. So it has been quite a short journey. So I think it's only 15 days, so I'm just getting a feel of the fund. So, but the thing is that, see, I like to talk about what you previously asked, and maybe that is it's also will be applicable to how I'm going to manage BSL 95 going forward. See, what I think is that there were certain trends that were playing out in the economy and in the other spaces, and we were thinking it will take 5 to 10 years for these things to penetrate deeply into the markets and to the economy as such, something like e-commerce, online, digital space, etc. But what has happened because of this crisis, that something that we were expecting to happen over the next 5 to 10 years has suddenly started happening within a month or so. So these trends have accelerated. So I think going forward, you might see, you'll see in the portfolios, you'll have. I would like to have much more exposure to companies which are involved in e-commerce, that digital something, and because of global supply chains getting disrupted because of the virus happening at different places at different points of time. So, we think there will be a now people will diversify their supply chains, and there will be certain sectors which will in which India will benefit, especially I think in the chemical space, in the specialty chemicals and agrochemicals. That is one space I think where India will benefit because of global diversification of supply chains, and I think that is where we will have increased exposure going forward. So, and also I think staples is where is a perennial performer, and I think that these staples are strong brands, etc., and they're going to play out. So I think those are the kind of things that will play out in the future, and maybe in BSL 95. So yeah, some of these trends will feature.
Okay, fair enough. Anil, a couple of questions now for you as well. But in particular, let me ask you this one first. Jay Shukla is saying, what about identifying small cap blockbusters, given that they are also today's large companies? How would one go about finding some of those gems in the stock market?
Sure. So, it's whenever you look at small cap, at least whenever I do look at any small cap, the first thing that you really do is look at businesses. You don't really go out looking for small caps or mid caps. You're basically looking for businesses which you think are going to grow and expand as the country's GDP expands. Then you start looking into that particular company's management, that particular company's track record, and in particular, what really do they have, that the moat, the uniqueness, the strength, and then, kind of start building a small exposure on a position, and gradually over a few quarters and a few possibly years, generally build a large exposure. That's the way you really know into any particular stock. In a small cap, it is relatively under-researched, number one. Number two, as I mentioned, it's most important to get the business right, in the sense there has to be expansion of business possibility, because there are many small cap companies which are very niche, but they have limitations in terms of the business, in terms of how much can they expand. And if you can't do that beyond a point, as a fund manager, you can't take a meaningful exposure, right? Because the fund sizes keep growing, and that's the issue. So you really need to focus on a couple of things. The first, as I keep saying, is business and the possibility to expand that business over a period of time, and then of course the capability of that particular management to take it forward.
Okay, I have a couple of questions here from some viewers, and I wonder which one of you would like to take this. One question says that you're talking about finding companies with a strong balance sheet, etc. But the fact that prices are already moving so high is a big risk, given that we still don't have a vaccine, etc. And we might actually continue to see retesting of lows in the market. How will mutual funds manage such an event? And then there is a question on a particular fund, the ABSL Pure Value Fund as well, which I'll get to in a moment. But which one of you would like to take this?
So the first part that you talked about is that about there being no vaccine, and how, as a mutual fund, how do you look at it? See, yeah, obviously I agreed there is no vaccine at this point in time, and when a vaccine is going to come, we don't have a clue at this point of time. So as I think that we hope that eventually in the period of time, even if the vaccine doesn't come, an effective treatment comes, which will give confidence for people to come out into the public and start working. And especially if you go back to see, people have been talking of a 1.5 year to 2 year period, but especially all those people go back to the Spanish flu times and see how long did it take for everything to normalize. The Spanish flu played out for 2 years and suddenly it stopped. And it was a much more, or at least as far the numbers go, the fatality rate was significantly higher than what the current virus has. So that's the max outside that at present that you'd like to take. But we hope that it will be much lower and gradually the treatment protocol and effective treatment will gradually come. And and these kind of things, especially when these are uncertain at this point of time, is especially important to invest in companies which suffer the least during the pandemic and will grow going forward. So these are companies that you'd like to own during a pandemic and also want to own after the pandemic is over. So, and typically these companies would have strong balance sheets, and apart from the characteristics that I said earlier, they especially also have strong balance sheets to withstand. So I think it doesn't change anything. Will continue to hold this.
Also, just to add to this, as Satya rightly mentioned, things like these pandemics last for 1 or 2 years and then go away. But for a long-term investor, many a times this gives a very good opportunity entry point into the markets. If you look at the last decade, we have seen GFC, global financial crisis, then you had taper tantrum, then you had peak crisis in the European markets. But each of these crises also bring with them an opportunity to invest into the markets at lower levels. So I think from a long-term investor perspective, such opportunities are the ones to capitalize upon.
All right. Ajay, lots of questions for you on the chemical sector, especially, also specialty chemicals is a sunrise sector, and one on telecom. A particular question coming in from Sholay saying you're overweight on chemicals and telecom. Do you start to see a payoff there?
So as I said, like I'm not a believer of a sector. It is all about companies, and probably there's one company which is from agrochemical space, agrochemical and seeds company. It is the largest agrochemical and seeds company globally. So that is where we have exposure across my schemes and across our fund house as well. And the company continues to do well. They saw acquisition, they saw a merger. In fact, they merged with the seed company, and merger benefits hopefully should seep in. So this is all about the chemicals, what you are talking about. Though I am not a chemical per se sector expert. On the telecom, I feel being an engineer, somewhat have a bit of a contrary approach for the sector, anything to do with technology. So for me, there's nothing called a first mover advantage. So once a player comes in, there are so many people coming into the sector, and the sector gets commoditized. We saw it on Android side, how many players had come in on the mobile side. We saw Nokia, we saw Motorola, and we saw a lot many others, Gionee, and now Gionee is no longer there. So it is all about a basket of how it is packaged. So like Amazon is a great integrated company. So is one of the Indian companies trying to package the entire thing, entire basket of things into a one stop shop. So it is going to be all about that rather than a sector which is called telecom. And I have, though I'm watching the events very closely, but this COVID kind of event is going to, we need to visualize what happens to life after COVID. vaccine is going to come in 3 months, 6 months, 9 months. It is going to happen across the globe. Scientists are working, and it is going to be coming in. But the time horizon, we are not sure. So if the vaccine was to come in say 3 months, then the portfolio positioning will be very different. And if it was to come in 6 months, portfolio positioning is going to be very different. But what is going to happen is like work from home culture has come up very well. TCS has said that was a public statement that 75% of the workforce is going to be working from home. Twitter, there was a tweet yesterday, I believe, that they are going to allow employees to work from home, whoever feels like. And so what we will discover is like companies are saving on the real estate cost. Employees are going to save on their travel cost, and that money is going to go somewhere. Probably the customer or the companies that were serving to some other company, probably those bills are going to reduce, or the selling price is going to reduce, or the margins are going to get recalibrated. But at the same time, we are going to see an increased pace of automation. And what some time back people were saying that 5G is not going to come, I feel that it is only going to accelerate the transition from 4G to 5G, where you will like to have faster speed and reliability on the data.
Anil, there's a compliment for you from somebody with an exposure to BSL equity, saying the clarity is very encouraging. So that's for you. Also, would you be able to answer this question on the hybrid 95? I get a couple of questions actually on the balance 95, and whether or not that's going to go through any kind of reshuffle.
So I think Satya would be the right person, since he's the one who's just taken over 95 a couple of weeks back, and he's already answered it. But you could please direct that question to Satya. I think it makes sense.
What exactly is the question?
There are a couple of questions, all alluding to whether or not you're going to change the kind of mix that's currently in the fund.
See, obviously, if you look at the kind of the way I invest, I mainly prefer growth-oriented investing. So that is the primary type of investing where I'm much more comfortable with. So obviously, over a period of time, the fund will reflect the style of investing that I'm comfortable with, but it will be a gradual process. It's not as if it's going to change overnight, because the markets are not liquid, and you just can't change your portfolio overnight, and you have to look at what the current price is and what are the market sentiments, etc. So a lot of things go into it, but obviously over a period of time it's going to reflect a more growth oriented kind of investing style, with a major portion of the investing in which will have more secular kind of growth. See, when I tell that growth kind of investing, I'm not telling that you shouldn't invest in a value fund, or I'm not telling that growth is a better way of managing a portfolio than value, or it's a better way than managing as momentum investing. So all these investings have proven themselves over a long period of time. So you can make a lot of money if you follow value. You can make good amount of money if you follow growth or you follow momentum. So it's more about what I'm more comfortable with. So I'm more comfortable with growth. So gradually, the fund will be restructured to a growth-oriented style.
Okay, and just to follow up on that, is there a tenure by which it can be expected to outperform its peers or the benchmark?
See, I would like that over the next 1 year we outperform the benchmark and our peers. So that will be our endeavor. So that over the next 1 to 2 years, we outperform our peers and the benchmark.
Okay. Now, the ABSL fund, which of you will be able to answer that? Because we've got a whole host of questions coming in on that.
Which one?
The ABSL Pure Value Fund.
Okay.
And the questions are largely ranging to whether or not it's going to recover anytime soon. And if one is already invested in it, is it really a case of money being stuck? I think it's a small cap fund.
See, if you look at it, pure value fund, when it started, it was mainly focused on investing on small and medium, basically the mid-cap value space, mid-cap and small-cap value space. So, but what has happened over the last 2 to 3 years? See, initially when we did it around 4 or 5 years, it was doing quite nicely. But gradually over the last 3 years, both globally and in the local markets, in the Indian markets, the value went out of favor, and it was more growth across the markets, both abroad and India. And apart from value going out of favor, what happened is that even in the growth, there was a huge concentration on few stocks. If you look at the ratio of Nifty divided by Nifty returns divided by Nifty equal weighted, or if you do Nasdaq divided by Nasdaq equal weighted, you will see that the ratios are at all-time highs. They're almost as if these ratios were there when the tech bubble happened. So obviously, when these things happen when the markets are extremely narrow, and the expectation was that the markets will broaden going forward, and the markets started broadening from the beginning of the calendar year, and they were gradually broadening over the next till March, and then the virus thing happened, and the markets further narrowed down sharply. So we think that going forward, the markets, as the virus thing stabilizes, the market will broaden, and we have made certain changes in the fund. So now the fund it still focuses on the value strategy, but the allocation has gradually shifted, and we have added more large caps than mid caps. So the allocation to large caps has gone up. Because the allocation to large caps has gone up, the fund is stabilized. In fact, the fund has done quite well during this pandemic period in the last 2 months, when there was huge amount of volatility. The fund has actually done well, which is mainly due to the changes in the portfolio that have been done by the fund manager. So going forward, if you look at the portfolio looks quite nice, and looks to be a tight, clean portfolio. And we think that if you stay invested for the next 2 to 3 years, the performance should come back.
Okay.
Adding to what Satya said, or generally as a house, we tend to be sticking to the label, basically. Like if it is pure value, we try to be on a value-oriented stocks, or if it is an MNC fund, we try to be on the MNC side rather than get into the hybrid characteristics.
Sure. Anil, a few questions here now alluding to, if you had to choose your portfolio, banking, pharma, how much weightage would you give each, and others? And amongst the others, what would it be if there was one predominant theme, or even a couple of other sectors that you look at?
So I'll tell you what the fund today that I run, which is the BSL Equity Multi-Cap Fund, and that should give you an idea in terms of what the weightages are and what I like, because that's displaying exactly what I like. So, healthcare as a vertical is about 15% weightage, 15, which includes pharmaceutical and healthcare, which is hospitals and pathology labs, etc. Banking and financial space continues to be in the region of about 30-32%. And I am quite largely overweight telecom. So these are the three large, overweight positions, which is, healthcare, telecom, and private banks. Most of the other positions are underweight to neutral. So, that should tell you a bit of a color. So, we are, from a question that you asked perspective, consumer as a sector, while it's a most evergreen sector and evergreen stocks in this country, the sector, unfortunately, the valuations continue to be extremely rich. as a fund manager, I kind of a more value focused on a value based fund management style. As Satya mentioned, he's more of a growth oriented. I'm more on the value side of the portfolio, on the fund side. And I pick more of the stocks which probably offer reasonable growth at reasonable valuations. That's my motto. That's the way I've run the fund in the last 7.5 years that I've been with Birla Mutual.
Okay, great. Just a closing comment then. I'm also just running through the questions in case there's anything we've missed.
Sure.
But I think largely people also just want to understand where we're at with the entire COVID scenario, how this perhaps changes any investment decisions, given that it's a never before seen event and there's so much uncertainty. And, would equities continue to be a safe place, whether it's through SIPs or otherwise? So just a short closing comment from you on that. Ajay, let me take one from you.
So above my feel is like, though we may go up and down on the market side, that will depend on variety of factors. But at the same time, we are surely going through a transition phase. And we have seen in 2008 to year 2000, not many companies, even if the market was going down and a couple of companies were making a new high, or in fact, large caps were shrinking and the small caps were graduating to mid caps and large caps. So it is all about the companies. We need to have our sixth senses. We need to activate our sixth senses or reactivate our sixth senses and see what is happening on the ground, and ultimately what are the businesses that are shaping up and handling the transition very well. And those are the businesses one needs to be in. And these are going to be winners of the next decade, and they can be 10x, 20x, 30x. So there's no limit.
Great. Anil, let's get your view as well.
Yeah, so, completely clear on one thing, focus on companies and sectors where India can be and is, a global force to reckon with in terms of, where we could really make a march. So if you go back to early 2000s, we had IT. Today, India is recognized all over the world for their software services. And, that's a sector which has grown by leaps and bounds. And had you been invested in that point of time there, you would have at least done 10x to 20x of your investments. Similarly, when you come to pharmaceuticals, we are almost 60% of global market share in terms of generics. It's had a couple of difficult years in the last few, but it's not taking away the fact that India has a huge advantage in terms of offering the world globally qualitative and competitive pricing generics. So that's another space to really invest in. So keep looking. Chemicals could be another space where India, over the next 5-10 years, will start dominating. So look for places where, and be early there, then the 10x and 20x is really possible. So I think these are the sectors I would really look at to be long-term investor.
Okay. Vishal, closing comments from you?
Yeah, sure. So apart from chemicals and pharmaceuticals that Anil alluded to, I believe insurance space is also something that would be a prime beneficiary of something like this, which is COVID-19 situation. We have seen in the past in the US markets, for that matter, that after a cyclone, a lot more people want to go for cyclone insurance, for that matter, for their homes. Similarly, we believe that there could be increased demand for both personal insurance as well as general insurance as we move on. And today in Nifty, there is not a single insurance company present, but I would not be surprised over the next 2 years, insurance might actually be 10% of the Nifty index. So that's something that within financials, I would be bullish on.
Fantastic. And finally, Satya.
Yeah, so see at the end, what I would like to say is that see there are this recession, the way I would classify it is as a event-driven recession. It's not as if it's a structural or cyclical recession. A structural or cyclical recessions are much more difficult to handle and take a long period of time to settle down and to come out of it. An event-driven recession is typically the smallest one, especially when you take care that it doesn't turn into a structural recession. So this being an event-driven recession, I think we will come out of it if the appropriate measures are taken by the authorities, which I think will be taken. So and to add to that, it's difficult to say where is the peak, where is the bottom, and all that, and trying to time the market. But definitely, one thing is sure is that when there is a significant deviation from the trend, especially when there is a significant deviation from the trend towards on the downside, and especially when it is what has happened now. And that is when it's an extremely good period of time to invest in equities. And recessions, if you invest in the time of recessions in equity, typically you tend to end up with significantly higher returns than the average.
Fabulous. It was great speaking with all of you, and I'm glad that your viewers got a chance to really ask you some of these questions up front, and a clear message coming through, which I think has been greatly appreciated. So thank you so much for all your time.
Thank you so much. Thank you. Thank you. Stay safe.
You too.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.